Let's turn to big bank earnings. They are rolling in today. Morgan Stanley reporting better than expected results, boosted by wealth management, trading, and investment banking. Profit jumping 32% from a year ago as deal-making rebounds. This following similar stories from Bank of America, from Goldman Sachs, and Citi earlier this week. Joining us now, we want to bring in Alison Williams, Director of Research for Bloomberg Intelligence's global strategy team. Alison, it's great to have you here on the program with us. So the CFO at Morgan Stanley characterized this quarter as a standout quarter to her. How would you characterize this quarter?
So I would characterize it as Morgan Stanley executing on a very strong environment. So the most important number we saw this quarter was the wealth flow number, so 64 billion, rebounding from a weaker second quarter. And that really exemplifies the health of the business. So, it's the markets help the assets under management, help the fees, and that's more meaningful for the top line in any given quarter. But the wealth flows really show, demand for assets and demand for new business at Morgan Stanley. Asset management also gathering flows on the alternatives and fixed income side. And then, of course, Morgan Stanley's trading does lean more towards equity trading. That was the biggest source of strength that we saw at all the global investment banks this quarter. We saw upside at all the banks: equity trading, FICC trading, debt fees, M&A fees, equity underwriting fees, a little bit mixed. But within all of that upside, really, the equities trading, the standout, and Morgan Stanley doing very well.
It's interesting, Alison. Some of the things that we had heard that seemed to be a common denominator about the strategy for all of these businesses over the quarter and what we heard on conference calls was diversification of their revenue and where they're generating that from. Who is doing the best from your perspective in that diversification of revenues that investors can really hang their hat on and see continued growth as they're looking across where those sources of driving even more sales or revenue are coming from?
So, Morgan Stanley and Goldman Sachs are the more focused banks in terms of focusing on the institutional business, whereas companies such as JP Morgan, Bank of America, Citi, and Wells Fargo are a little bit more diversified. Wells leaning more towards the regional banking business. JP Morgan, really the leader in returns on tangible equity, diversified and winning across the platforms. But Bank of America also sort of similar in that footprint. I would say that Citigroup is instead of diversifying, is narrowing its business. And we think that's a good thing because they're getting rid of the marginal, less profitable businesses and looking to focus on something like wealth management, which is a business that they, basically sold to Morgan Stanley in a series of steps. Goldman Sachs also, I would say, is the opposite of diversification. They're narrowing their footprint, and I think that's helping them focus on their core business. So of all the banks, Morgan Stanley has been the one that had the biggest change in its model over the last decade or so, and that was really through a series of acquisitions under Gorman. Gorman did set out a series of very aggressive targets for the business that Ted Pick is now taking over and having to deliver on. But certainly in this quarter, he is delivering it. And the shift really is towards wealth management, where there was upside in the quarter. And again, the flows are important, but the institutional business has really been the standout and drove the top line surprise.
And Alison, looking ahead here, Ted Pick also calling out the evolving interest rate environment, a potential tailwind here for the bank. I'm curious from your perspective, how big of a catalyst do you see this through year end? And then, of course, looking ahead to 2025.
So one of the big stories that the banks have been talking about and investors are focusing on is that investment banking fee recovery. So in 2021, we really just saw a blowout year hitting on all cylinders for M&A, equity underwriting, debt underwriting. Since that, obviously things corrected the following year and just has not really recovered. I would say that in 2024, debt fees have really been very strong, but equity fees and M&A fees are really just recovering. And I think that is what Morgan Stanley is focusing on. Could we be at the beginning of a multi-year recovery? Some of the work done by our team supports this. M&A is at, we expect could go from a low of measured as a percentage of the market capitalization of the world, more towards the higher end of that. And we do think that the IPO market also shows signs of recovery. One last thing I'll leave you with is, Goldman Sachs, who is the leader in M&A revenue, did see an increase in their backlog. And so we do expect that's a source of fees that will be strong in the fourth quarter.
Alison Williams, Director of Research for Bloomberg Intelligence's Global Strategy Team. Alison, thanks so much for taking the time here with us this morning.
Thanks for having me.